I don't think there was any economist I've ever read that talked about negative interest rates for long periods of time. I mean, if they do not get into a negative rate environment, I think now there's still 11 trillion that's of government debt around the world that's at a negative rate. So we've never seen it before, and we've never seen extremely low interest rates and really very little inflation. I've been surprised by all kinds of things in the last 10 years about the economy. I mean, I don't think there was any economist I've ever read that talked about negative interest rates for long periods of time. I mean, if you go back and read Keynes or you read Samuelson, you read any of them, they do not get into a negative rate environment. I think now there's still 11 trillion that's of government debt around the world that's at a negative rate. So we've never seen it before, and we've never seen, at least the conventional wisdom, on a sustained period of long and growing deficits while the economy is getting better, extremely low interest rates, and really very little inflation. So something different is happening, but something different happens all the time. So, and that's one reason economic predictions just don't enter into our decisions. Charlie Munger, my partner, and I, we've never made a decision based on an economic prediction. We make business predictions about what individual businesses will do over time, and we compare that to what we have to pay for them. But we have never said yes to something because we thought the economy was going to do well in the next year or 2 years, and we've never said no to anything because we were right in the middle of a panic, even if the price was right.
Well, they were going to be negative for a long time. You better own equities, or you better own something other than debt. I mean, it's remarkable what's happened in the last 10 years. I've been wrong in thinking that you could really have the developments you've had without inflation taking hold. But we have 120 odd billion. Well, we have some almost very high percentage in treasury bills, some and some just in cash. But those treasury bills are paying us virtually nothing. Now, they're a terrible investment over time, but they are the one thing that when opportunity arises, it will arise at a time, and maybe the only thing you can look to pay for those opportunities is the treasury bills you have. I mean, the rest of the world may have stopped. And we also need them to be sure that we can pay the liabilities we have in terms of policyholders over time, and we take that very seriously.
Well, if you have to closely follow a company, you shouldn't own it. If you buy a farm, you go up and look, every couple of weeks to see how far the corn is up, and do you worry too much about whether somebody says this is going to be a year of low prices because exports are being affected or anything like that? You buy a farm and you hold it for. I've got one farm that I bought in the 1980s, and my son runs it, but I've been there once. I mean, it doesn't grow faster if I go and stare at it. I can't cheer for it. More effort, or something like that. And I know there's going to be some years when prices are going to be good, and some when prices aren't going to be good. I know there's years when yields will be better than others. But about the farm, I don't care about economic predictions on it or anything of the sort. I do care that over the years it's well tended to, and in terms of rotating crops, and I hope yields get better, which they generally have. If you own the best auto dealership in town, the best brand, and you had somebody good running it, you wouldn't drop by every day and say, how many people have come in today, or I think interest rates are going up a little, maybe it'll slow down our sales or anything. No, you buy it knowing there's 365 days a year, and you're going to own it for 20 years, so that's 7,300 days, and things are going to be different from day to day and year to year. You shouldn't buy it at the day-to-day stuff. There's so many variables. I mean, in the hard sciences, that if an apple falls from a tree, that it isn't going to change over the centuries because of anything or political developments or 400 other variables that go in. But when you get into economics, there's so many variables, and the truth is, you've got to expect good times and bad times in business. And if you If you were to buy an auto dealership in your, wherever you live locally, or a McDonald's franchise or anything like that, you wouldn't try and time the purchase. You'd try and make the right purchase at the right price, and you want to be sure you got a good business. But you wouldn't say, I'm going to buy it because growth this year is going to be 3% instead of 2.8% or something of the sort.
If the world turns into a world where you can issue more and more money and have negative interest rates over time, I'd have to see it to believe it, but I've seen a little bit of it. I've been surprised, so I've been wrong so far. I do not think that, I don't see how you can create, I would say this, if you can have negative interest rates and pour out money and incur more and more debt relative to productive capacity, you'd think the world would have discovered it in the first couple thousand years rather than just coming on it now, but we will see.
Generally speaking, when companies are sold, they sell at premiums. Now, they sell at premiums because the buyer thinks they can do all kinds of wonderful things with it that the present management isn't doing. I've often said that, on the Fortune 500, maybe 250 companies should buy the other 250, and they just totally shift every year because everybody thinks they can run it better than the next guy, which is what you're saying when you buy it in its entirety. I don't think we can run anything better than the people that are running when we buy it. So it's hard for me to get to a premium, and the premiums have gotten more dramatic, and the leverage available has gotten pretty generous, and that causes people to buy it. People love to buy what they can't pay for. Basically, if somebody will also put up the money, and we don't calculate leverage into any of our purchases. In other words, we don't say, if we buy this thing for $10 billion, we can borrow $7 billion against it, because we're really using up Berkshire's general credit. I mean, I could apply 70% leverage to any one of our companies and make it look better. But the truth is, it's the general credit of Berkshire that's doing that. So it'd be crazy to, just because I want to buy something, say, well, I'm buying this with 70% leverage, so therefore I can pay this kind of silly price.
If you can have negative interest rates and pour out money and incur more and more debt relative to productive capacity, you'd think the world would have discovered it in the first couple thousand years rather than just coming on it now, but we will see. It's probably the most interesting question I've ever seen in economics is can you keep doing what we're doing now? And we've been able to do it, or the world's been able to do it for now a dozen years or so, but we may be facing a period where we're testing that hypothesis that you can continue it with a lot more force than we've tested it before.
They're businesses I understand, and I like the price at which they're selling relative to their future prospects. I think 10 years from now that they'll be worth more money, and I feel there's a very high probability I'm right. And I don't think they'll turn out to be the best investments at all of the whole panoply of things you could do, but I'm pretty sure that they won't disappoint me.
We're doing things that we really don't know the ultimate outcome to. I think in general they're the right things, but I don't think they're without consequences. And I think they could be kind of extreme consequences pushed far enough, but there would be kind of extreme consequences if we didn't do it as well. So somebody has to balance those questions.
Well, if you're running a deficit getting close to 5% when things are really good, that's a new world. And neither the Republicans or Democrats are particularly concerned about it. And we're not having a lot of inflation. That wasn't supposed to happen, but it's happening. And that's why I say you don't want to get hung up on trying to make economic analysis, because nobody's any good at it. You don't get rich doing that. If you look at, I mentioned that Forbes list, if you get on the list, the number of people that have done that by economic analysis, I think are just about zilch on that. If somebody told me 10 years ago what was going to happen in the next 10 years, we could have made a lot of money in the bond market together, but there's always a reason afterwards. Tomorrow's paper will say stocks went down today because of, but they didn't write it this morning's paper that stocks are going to go down today. You have to know what you don't know, and you have to make sure that what you don't know isn't all important. I mean, if there's 4 boxes there, you want to get to what is knowable and which is favorable. And there's things that you'll miss out on because they belong in the other 3 boxes, one of which will be favorable, another one favorable. And the fact that you're missing out on 90% of the stuff doesn't really make any difference if the 10% you do is right.